BlackRock manages more money than the GDP of every country except three, and almost nobody knows how it happened. The story everyone tells you is simple. BlackRock is big because it's good at investing. The company picks winning stocks, crushes its competitors, and grew rich by being smarter than everyone else. That's the accepted narrative. It's also almost entirely wrong. Here's the trick: BlackRock didn't win by picking better stocks. It won by changing what it meant to be an asset manager entirely. Let's start in 1988. A group of former Salomon Brothers traders, including Larry Fink and Rob Capito, launched BlackRock from a single room in New York. They had no retail customers, no brand recognition, and no special insight into stock picking. What they had was an obsession with risk modeling, the mathematical machinery that could predict how portfolios would behave under stress. This is where the fork in the road appears. Most asset managers of that era, Fidelity, Vanguard, others, made their money the traditional way. They charged fees on the money they managed. A client gave you $1 billion, you charged them 1%, earned $10 million a year. Simple. BlackRock did something different. They built software. The software was called Aladdin, and here's the trick: Aladdin wasn't designed to make money directly. It was designed to solve a problem that nobody else could solve. How do you manage risk across thousands of securities, across dozens of asset classes, across global markets, all in real time? That's not a software problem. That's a science problem. BlackRock spent the 1990s and early 2000s refining Aladdin while other asset managers were focused on quarterly returns. BlackRock was focused on understanding volatility, correlation, and tail risk. When the 2008 financial crisis hit, something remarkable happened. BlackRock's models didn't just survive, they predicted the cascade before it fully detonated. The government noticed. The Federal Reserve, the Treasury Department, and the SEC all turned to BlackRock and asked a simple question: can you help us understand what's about to break? BlackRock said yes. And in that moment, the company transitioned from being a money manager to being something far more valuable: a systemic risk advisor. Follow the cash line here. BlackRock didn't charge the government like a consulting firm. Instead, it accumulated something worth far more: access. The company got to see what regulators were worried about. It got to understand government thinking before it became policy. And it got to position itself as indispensable to financial stability itself. But the real conquest started in 2012. That's when BlackRock acquired iShares, a collection of exchange-traded funds, or ETFs. Most people saw this as a smart product play. BlackRock saw something else: the future of how money moves. Here's why this matters. ETFs are passive. They don't try to beat the market, they match it. They're cheap. A client pays 0.05% instead of 1%. And here's the trick: they scale infinitely. One ETF can hold billions of dollars. The more money flows in, the cheaper it becomes to operate. While other asset managers were still charging 1% to pick stocks, a business that requires constant skill and constant work, BlackRock was building a machine that charged 0.05% and got cheaper as it grew. And as markets shifted toward passive investing, the machine didn't just grow, it became unstoppable. By 2015, BlackRock had become the world's largest asset manager, not because it was the best stock picker, but because it had built the most efficient machine for managing capital at scale. It owned iShares, it owned Aladdin, and it owned relationships with every central bank on Earth. The numbers tell the story. In 2008, BlackRock managed roughly $1.3 trillion. Today, it manages nearly $10 trillion. That's not growth, that's conquest. And it happened because the company understood something fundamental that competitors missed. The future wasn't about being smarter, it was about being systematic. Now trace where the influence actually lies. BlackRock doesn't just manage money for individuals and pensions, it manages money for other asset managers. It manages money for sovereign wealth funds. It manages money for governments. And through Aladdin, it advises central banks on decisions that affect billions of people. Here's the real trick: BlackRock's power isn't in what it owns, it's in what it knows. When you have visibility into the flows of trillions of dollars, when you understand where capital is moving before the market does, you're not just an asset manager anymore. You're infrastructure. The quiet conquest wasn't about beating competitors in returns. It was about building a system that competitors couldn't compete with. BlackRock didn't become the world's largest asset manager because it was the best at picking stocks. It became the world's largest asset manager because it built the infrastructure that the entire financial system now depends on. And that shift from being a money picker to being the system itself is where the real story of BlackRock's influence lies. Not in stock picks, not in fees, but in the fact that regulators, governments, and central banks all turn to the same company to understand financial reality. That's power. And it was built slowly, methodically, by following the cash and understanding that the future belonged to whoever could systematize capital flow at scale. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe, there's a new unsolved business conquest every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.